Back to the Markets Upchuck. And today's blog is titled The Essence of Valuation Part 2, where we look at pure growth and how important the PEG ratio is in ascertaining intrinsic value of a fast-growing company. For example, if you look at a company like Fiserv that's had a historical earnings growth of 18.6%, you can see that this company has consistently grown earnings, which is the blue line here with the asterisk, and there's also a green line with a triangle that are actually the same line. And then you have the black line, which are the stock prices. And clearly, it's been the long-term earnings growth that stock price has correlated to. And the other thing about all these charts, and I want to point out as I'm going through them, is you can look at these charts and have a clear perspective of valuation. When the black line is touching the earnings lines, clearly the stock is at a reasonable valuation. When the price line is above it, you can clearly see it's overvalued, and when it's below it, it's undervalued. So one of the things that having an understanding of this relationship between the rate of change of earnings growth, how fast a company grows, and how the market would normally price that is critical for investors when making investment decisions. So, let's just kind of test the hypothesis. Here we have Fiserv, an 18.6% growth rate, a little bit of undervaluation, and you have the company, generating about an 18% rate of return to shareholders. It's this rate of change of earnings growth that is so critically important in determining what the shareholders earn. My second example is Aflac. It's about a 19.5 to 20% grower. This company does pay a nice dividend. It has for several years. What's interesting here is look how closely the stock price correlates until we get into the recession. One thing that I want to point out, the current recession and this, major bear market, this once in a 100-year event that we've had really does distort these things, but it does not change the principles that we're talking about here. You can see Aflac stock price trying to come back to its intrinsic value, but even here I want you to notice how a 20% growth rate led to a strong 14.5% rate of return to shareholders, much better than the market, because ultimately it's the rate of change of earnings growth and valuation. And Aflac has been very normally valued, a couple little periods of overvaluation most of this period except currently. O'Reilly Automotive is another kind of fast-growing company. I particularly like this chart to make a couple of points. One is you can see a very strong, consistent earnings growth, about 18.5%. The company starts out pretty much in value, ends pretty much in value, maybe a little overvalued. So this 18.5% growth of earnings generates an 18.7% return to shareholders. We only have a 17-year chart here because that's as long as it's been public, and there's that's compared to a 4.5% S&P 500. But you can also, by looking at this chart, one of the things that's really powerful about understanding that there is a correlation and relationship between earnings and market price is when you look at this chart, you can clearly see the periods of overvaluation, fair valuation, and undervaluation. Obviously, you don't want to be buying O'Reilly here, even though it's still just as good a company there as it is here. You want to buy it here when the price is reasonably priced, or you want to buy it here when it got undervalued in June of 2008, because ultimately it's the rate of change of earnings growth coupled with the valuation you pay that's going to determine how well you do as a shareholder. And again, an 18.5% growth rate, 18.7% rate of return. Just kind of repeat myself, Danaher, very consistent correlation between the company's rate of change of earnings growth. You can clearly see overvaluation when it exists, and you should be able to clearly see, at least in my mind's eye, how undervalued the stock currently is today. A 20% grower over a period of time generated just under an 18% rate of return for shareholders. Let's kind of move on to a little bit of starting to get some faster growth. Here's Teva, a 25% grower, 24.7. You can see there's been one period of overvaluation. Otherwise, there's been a good correlation. We've had some undervaluation. Stock price came back. We currently have some undervaluation right now. We think this is a very well-positioned company for the future based on the fact that generics are, the future of pharmaceuticals. Company generates a 23.9% rate of return for shareholders, which correlates very closely to the 24.7% rate of change of earnings growth. Earnings determine market price in the long run as long as you pay an intelligent valuation when you purchase. ITT Educational, I've shown this one a lot of times. Look how perfect the earnings growth is here, over 27%. You can see a PEG ratio concept here where the price-earnings ratio equals to the growth rate. You can see periods of over and undervaluation when they occur. And again, a 29% rate of return to shareholders that correlates to the earnings growth of the company. Here's Coach, no debt on the balance sheet, very fast-growing company, a little blip here, in the recession, but I want to point out, very, very profitable company with no debt in the balance sheet. But look how the stock price, was calculated or correlated to its growth rate. Now, when you start getting up to 30, 35, 40% growth rates, the PEG ratio, as I mentioned in my written part, starts to wane, but you still end up with very high price-earnings ratios. Normally, this is a 25 to 30 multiple company. As you can see, the blue line is 27 times earnings. Its growth rate has been over 37% a year, and interestingly enough, this has generated over its 10-year existence as a public company about a 29% compounded return during the period when the market actually lost money. So even at these low valuations, you can see the importance of earnings growth and how, as I said in the written part of the post, if you're growing earnings very fast and you start out with 11 cents in earnings and that grows to over $2 or around $2 worth of earnings 10 years from now, when you're capitalizing this much larger stream of income that you have here, you're going to make some money even if you find a bad market like we're in today. Cognizant Technology, this is the Coach story, deja vu all over again, as Yogi Bear would say. Look how closely stock prices correlate. You can see the periods of overvaluation and undervaluation, but you had enormously strong earnings growth of 43%. In this case, the stock price did stay pretty close to its, multiple of around 41 times earnings. And therefore, at 16 times earnings, the stock is clearly on sale, even if the growth rate is slowing, and it probably is. But here's a company that generated a 33% rate of return to shareholders over an 11-year period, where the market actually lost a compounded 3% a year. Earnings determine market price, especially if valuations are in line at the time of purchase. And then finally, Priceline. You have a company here that's been growing like a weed. It's been growing at over 56% a year. The price-earnings ratio has been very high. It doesn't quite equate to its growth rate, as I point out in the blog. It's still very high. Here's a company that's clearly on sale, again, thanks to the recession in the market. The market's created a lot of opportunity, especially in these faster-growing companies, to be able to buy them at price-earnings ratios that are severe discounts, to their long-term growth potential. But here's the point. Here's the closing point. The idea here is that as an investor, you should always be making your investment decisions based on a realistic rate of return expectation that's based on the attributes and characteristics of the company. If you have companies that are growing at, 6, 8, 10, 12, 14%, then it really comes down to the Graham-Dodd model that we talked about yesterday. To keep in mind, if you're paying something around 15 times earnings, you only can expect to earn the 5 to 10% rate of return plus some dividends that the company is offering. It's not until you get into the faster growing companies like we're discussing today where you can start getting higher rates of return. But typically you don't get any dividends here, so you're taking some higher risk. You end up paying higher multiples, but you also have a significantly higher long-term rate of return potential, if your forecasts and estimates are right and you pay the right valuations. I hope this added some insight into the investing process. Chuck Carnevale saying thanks for listening. I'll talk to you again tomorrow.